Tonight, as you drift into slumber, picture markets as gentle currents in a vast ocean of time. They flow with the quiet rhythm of centuries, carrying ideas and wealth like silent tributaries. Markets began as simple whispers between people who understood that exchange could be mutually beneficial. They evolved not through force, but through countless small agreements, each adding another gentle current to the whole. As you tuck yourself in and let your mind wander back through time, imagine the very first marketplace, a place where two people recognized they both had something the other needed. Let's close our eyes for a moment and imagine a time before stock exchanges, before digital screens, before even the concept of money as we know it today. Picture yourself walking along an ancient riverbank, perhaps in Mesopotamia, where the Tigris and Euphrates rivers flow gently toward the sea. The air is warm and carries the scent of damp earth, of spices from distant lands, of animals and people and life. Here, in these fertile crescent civilizations around 3000 BCE, something remarkable was happening, something so fundamental to human nature that we still carry it with us today. People weren't just surviving, they were exchanging. A farmer with surplus grain might trade with a potter who crafted vessels for storage, and that potter might trade with someone who gathered precious stones from the mountains. This was the gentle birth of commerce, not in grand buildings or formal institutions, but in the natural rhythm of human connection. Think of it like a slow, meandering river. At first, just a trickle, a few people meeting at natural gathering places, perhaps a well or a crossroads. But as more people came, drawn by the promise of what others had to offer, those trickles became streams, and those streams flowed together into something larger. These weren't markets in the modern sense, but rather organic expressions of a simple truth. We all have different gifts, different needs, and when we share them, everyone benefits. The earliest forms of trade were barter systems, direct exchanges of goods for goods, services for services. You might imagine it as a quiet conversation between neighbors. I'll give you this basket of dates if you help me repair my home. There was no money changing hands, just an understanding, a handshake, a mutual recognition of value. As civilizations grew more complex, these informal exchanges naturally evolved into something more structured. By around 2000 BCE, in places like ancient Babylon, we begin to see the emergence of marketplaces, designated spaces where trade could happen regularly. Picture a shaded plaza, perhaps near a temple or palace, where merchants would spread their wares on simple cloths. There would be textiles dyed with colors from faraway plants, metals shaped into tools and ornaments, grains and fruits from different regions. And what made these marketplaces possible was a new invention: money. Not coins yet, but standardized measures of precious metals like silver. Think of these metal ingots as the first common language of value, a way for people who spoke different languages, came from different cultures, to understand each other. If you were a merchant from another city, you didn't need to know exactly what the local farmer wanted in trade. You just needed to know that your silver had value here too. Now let your mind drift forward through time to the great empires of Greece and Rome. Here, the marketplace took on new dimensions. The Greek agora was more than just a place to buy and sell. It was the heart of civic life, where philosophy was debated alongside the price of olives, where politics and commerce flowed together like two streams joining a river. In Rome, the Forum Romanum served a similar purpose, with specialized markets for different goods. And along the vast network of Roman roads, trading posts sprang up like resting places along a journey, connecting the far reaches of the empire through a gentle web of exchange. During this time, the first proper coins appeared, small discs of metal stamped with images of rulers or gods. These coins were like little promises, carrying the authority of an empire in your palm. They made trade simpler, more fluid, like water finding its level. As the Roman Empire faded and Europe entered what we sometimes call the Dark Ages, you might think commerce would have disappeared. But human connection finds a way, even in difficult times. Trade continued along ancient routes, carried by traveling merchants and protected by local lords. And then, as Europe began to stir from its long sleep in the Middle Ages, something beautiful emerged: the trade fair. Picture this, if you will. Once a year, perhaps at the crossroads of important routes or near a religious site, a temporary city would spring up. Merchants from across Europe and beyond would gather, their wagons filled with silks from the east, wool from England, spices from the Mediterranean, furs from the north. These fairs were like seasonal festivals of commerce, lasting for weeks, with their own temporary courts to settle disputes, their own weights and measures. The Champagne fairs in France were particularly famous, their name evoking not just a region but a feeling of celebration, of coming together after long journeys. At these medieval fairs, we begin to see the earliest hints of what would become modern finance. Merchants developed systems of credit, promises to pay later for goods received now. They created letters of exchange that could be transferred from one person to another, avoiding the need to carry large amounts of coin over dangerous roads. Think of these innovations as the first gentle currents of what would become the great river of finance, still small, still tentative, but flowing with purpose. These were the ancestors of our checks and credit systems, born not in banks but in the practical needs of people connecting across distances. And so, as we rest here in this moment between ancient exchanges and what comes next, consider this simple truth. Markets have always been at their heart about human connection. They began with people looking into each other's eyes, recognizing mutual need, and finding ways to help each other thrive. The physical marketplace, with its sounds and smells and textures, wasn't just an economic space, it was a social one, a cultural one. It was where news traveled, where ideas mixed, where the world felt both vast and intimately connected. This human impulse for exchange, for finding value in sharing what we have with others. This is the quiet, gentle current that has flowed through all of human history, from those first riverbank meetings to the grand trade fairs of medieval Europe. And as we prepare to drift forward in time toward new forms of connection and exchange, remember that all the complex financial systems that would follow, the companies, the stock exchanges, the global markets, all grew from this simple human beginning. Like a great tree whose roots stretch deep into fertile soil, modern finance draws its strength from these ancient exchanges, from marketplaces where people met not just to trade goods, but to connect as human beings, sharing their lives and their livelihoods in a gentle dance of mutual benefit. And with that thought resting gently in our minds, we begin to sense the first stirrings of a new era, where these human connections would take shape in forms both familiar and entirely new. Picture a ship solitary on a vast ocean, wind filling its sails, carrying it toward distant horizons where fortunes await in exotic spices, silks, and precious metals. For centuries, that was the image of maritime trade, a single vessel, perhaps funded by a wealthy merchant or a royal patron, venturing into the unknown with all the risk concentrated in one place, with one cargo, one voyage. But around the turn of the 17th century, a remarkable innovation emerged in the quiet, pragmatic corners of the Netherlands that would change the nature of business forever. This was the Joint Stock Company, and its most famous creation was the Dutch East India Company, which we remember as the world's first publicly traded corporation. Imagine, if you will, that instead of asking a few friends to help you build one boat, you instead invited an entire community to participate, not in building one boat, but in creating an entire fleet. Each person contributes what they can, from modest savings to substantial wealth, and in return receives a piece of paper that represents their share of the whole enterprise. These pieces of paper aren't promises for a single voyage. They represent an enduring share of the company itself, with value that rises and falls with the company's fortunes. This was the essence of the joint stock idea, spreading risk across many investors, pooling capital on an unprecedented scale, and creating businesses that could endure beyond any single voyage or season. The Dutch East India Company came into being in 1602 through government charter, a unique entity granted monopoly rights over Dutch trade in Asia for 21 years. This wasn't just a trading mission. It was a state-sponsored enterprise with the power to wage war, establish colonies, negotiate treaties, and even coin money. The scale was breathtaking. The initial capital raised was more than 6.4 million guilders, equivalent to about $100 million in today's currency. This wasn't money gathered by a handful of aristocrats, but rather collected from thousands of ordinary Dutch citizens, merchants, craftspeople, even widows with small nest eggs. What made this arrangement so revolutionary was how it separated ownership from management. Shareholders owned pieces of the company, but didn't need to be involved in its day-to-day operations. They could simply hold their shares and hope the company prospered. This might sound perfectly normal to us today, but it was a profound shift in the 17th century. Before this, most businesses were partnerships where owners were also managers, and their liability was unlimited. If the business failed, creditors could seize their personal assets. The Dutch East India Company introduced the concept of limited liability, protecting investors' personal assets from the company's debts. Think of it like a garden collective. Suppose you and your neighbors want to create a community garden, but you need substantial funds for irrigation, fencing, tools, and seeds. Instead of asking one wealthy neighbor to fund everything, everyone contributes a small amount. If the garden flourishes, everyone shares in the harvest proportionally to their contribution. If there's a drought or pest infestation, no single person loses everything. The loss is distributed across all participants. And crucially, if the garden fails completely, you don't lose your home. You only lose what you invested in the garden project itself. That's essentially how joint stock worked, but on a scale that spanned continents and oceans. As the Dutch East India Company grew successful, and it was tremendously successful, paying dividends sometimes as high as 40% in its early years, something interesting happened. Those pieces of paper, those shares, became valuable in themselves. They could be bought, sold, and traded. A widow in Amsterdam who had invested a modest sum might find herself needing money for an emergency. Instead of waiting for the company's annual dividend, she could simply sell her share to someone else who wanted a stake in the company's future profits. And as more people wanted to buy and sell these shares, informal trading arrangements began to emerge. Trading didn't happen in any formal building at first. Imagine a quiet canal bridge in Amsterdam or a coffee house where merchants gathered. That's where share trading began, informal meetings between people who owned shares and people who wanted to buy them. But as the volume of trading grew, and as more companies issued shares, these casual arrangements became increasingly impractical. How did you know who owned what? How did you ensure transactions were legitimate? How did you establish fair prices when there was no central marketplace to compare offers? This growing need for organization, for a place where buyers and sellers could reliably meet, would eventually give birth to something more structured than a bridge or coffee house. It would create the first stock exchange. But that transition happened gradually, naturally, like a stream finding its course down a mountain, first as trickles of informal trade, then as gathering currents of organized commerce. And at the heart of this evolution was a simple but profound insight that ownership could be divided, traded, and made liquid, transforming static capital into something that could flow through an economy like water, through a living system. As the evening settles softly around you, consider how quiet innovations in Old Amsterdam created a framework that would eventually connect distant corners of the globe. Shares, dividends, limited liability. These weren't just financial terms, but concepts that allowed ordinary people to participate in grand ventures, to share both risks and rewards across vast distances and time. And as we'll see, once these trading instruments existed, they needed a home, a place where they could be bought and sold with the calm rhythm of regular commerce, rather than the occasional happenstance of a chance meeting. But that is a story for another gentle evening. Imagine, if you will, the winding cobblestone streets of London in the 17th century, a city awakening to a new rhythm of commerce. The heavy wooden wheels of carriages rumble over uneven stones, creating a distant, percussive backdrop. Shopkeepers raise their shutters with a gentle clatter, and somewhere a new kind of space is opening its doors, filling the air with an unfamiliar, rich aroma that will come to symbolize not just a beverage, but a revolution in how people gather to trade. The coffee house. That's where our next chapter begins. In these warm, smoky rooms where commerce found its voice. Before coffee houses became centers of financial exchange, they were simply places of conversation. Think of them as the earliest social networks, physical spaces where merchants, ship captains, scholars, and travelers would gather to share news from faraway ports, to discuss politics, to debate philosophical ideas. And in the corners of these rooms, amid the steam rising from cups and the soft murmur of discussion, people began to show each other slips of paper, notes promising delivery of goods, shares in ships about to sail, or rights to future harvests. The air was thick, not just with the scent of roasted beans, but with potential. One particular establishment stood out among these early gathering places: Jonathan's Coffee House in Change Alley. Picture its warm interior, wooden beams overhead, walls paneled in dark oak, small tables scattered with cups and papers. Men in wigs and long coats leaning in close to study handwritten lists of prices. The atmosphere would have been one of intense focus softened by camaraderie. This was where John Castaigne first began to post regular lists of stock and commodity prices, creating something remarkable, a published record of what things were worth. A gentle rhythm of commerce emerging from the chaos of individual deals. Now, let's think about what was happening in these spaces. Before organized trading floors, imagine a marketplace so physical that you had to be there to participate. No telephones, no telegraphs, certainly no digital screens. If you wanted to buy shares in the East India Company or insure a ship bound for the Caribbean, you had to go to the coffee house, find someone with what you wanted, and negotiate face to face. It was commerce as conversation, as relationship building, as personal trust manifested in handshakes and written promises. From this intimate setting emerged something quite theatrical: the open outcry system. Picture this scene: Men standing in a designated space, perhaps around a pillar or in a cleared area of the coffee house, using elaborate hand signals and shouting prices to one another. It might seem chaotic to our modern sensibilities, but there was a beautiful logic to it. Like a complex dance where every gesture had meaning, a touch to the forehead meant buying, a palm pushed outward meant selling, fingers held up to indicate quantities. Shouted numbers cutting through the general hum of conversation. This was the market making itself visible, audible, turning intention into action through a shared language of movement and sound. Think of it as a kind of living clockwork mechanism. Each trader was a gear, their shouts and gestures interlocking with others to create a system that could process information and arrive at prices with remarkable efficiency. The noise wasn't chaos. It was consensus being formed in real time. A price discovery mechanism that relied on human eyes meeting, voices carrying across crowded rooms, trust being built in the space between bids and offers. The market had developed a voice, sometimes loud, often urgent, but always communicating something essential about what people wanted and what they were willing to give. As these practices solidified, something fascinating happened. The coffee houses specializing in particular kinds of trade began to transform into more formal institutions. Jonathan's evolved into the London Stock Exchange. Lloyd's Coffee House became the famous insurance market. These weren't abrupt changes, but gentle evolutions, like a river carving its bed deeper over centuries. The same people doing the same things, but now with agreed-upon rules, with regular hours, with clear membership requirements. The market was growing up, organizing itself, finding structure within what had begun as spontaneous gatherings. And in these emerging exchanges, the open outcry system became more refined. Designated trading pits replaced open floor space. Specific hand signals became standardized across different markets. A hierarchy developed: floor traders in colorful jackets, brokers representing clients, specialists maintaining orderly markets. The dance became more choreographed, but still fundamentally human, still dependent on that face-to-face connection between buyer and seller. The market had become a stage, and every trader was both actor and audience member in the daily drama of price discovery. But all this physicality came with limitations. The market could only move as fast as a shout could be heard, as far as a hand signal could be seen. It was bound by geography, by the acoustics of a room, by the stamina of human voices. And as the volume of trading grew, as more people wanted to participate, as information traveled faster from distant places through emerging technologies like the Telegraph, this beautiful, noisy physical system began to strain at its seams. The market was outgrowing its first organized home, even as that home represented such an important step forward from the purely chaotic exchanges of ancient marketplaces. The coffee houses had served their purpose beautifully. They gave commerce a gathering place, a set of developing norms, a way to transition from purely personal exchange to something more systematic. They created communities of trust in an age when trust had to be built face to face. And the open outcry system they fostered gave markets a voice, a literal, audible presence in the world. But as we'll see in our next chapter, that voice was about to undergo another transformation, one that would carry it beyond the crowded rooms of London, beyond the limits of human lungs and gestures, into a new era of connection. A quiet evolution was beginning, one that would eventually replace the shouts with clicks and the hand signals with digital pulses. But that's a story for another moment. For now, just rest with the image of those warm, smoky rooms filled with the gentle clatter of cups and the rising chorus of commerce finding its first organized voice. As we continue our gentle journey through the evolution of markets, we arrive at a pivotal moment, the establishment of formal exchanges. Imagine, if you will, the scattered informal gatherings we've been contemplating, slowly coalescing like raindrops on a window pane, joining together to form larger streams of water, each following the pull of gravity downward. That's what happened with trading. All those coffee house transactions, those tavern agreements, those street corner deals, they began to seek more permanent homes, more reliable structures where commerce could flow predictably day after day. London led the way. By the late 1600s, the Royal Exchange had become a hub for merchants. But the noise and chaos, well, it became too much for some. A group of stockbrokers seeking a quieter space began meeting in the coffee houses nearby. Then, in 1773, they took a significant step forward. They formally named their gathering place the Stock Exchange and occupied a building in Threadneedle Street. This wasn't just a new location, it was a new commitment to order. They established rules for membership, for conduct, for how trading should happen. Think of it as creating a garden where before there was only wild growth. They planted hedges, laid out paths, created beds where specific flowers could thrive. All to make the ecosystem more predictable, more beautiful, more sustainable. Across the Channel in Paris, a similar transformation was unfolding. The Paris Bourse, established in the early 1700s, began in the open air near the Palais Royal, then moved to more formal quarters. The French approach had its own elegance. Trading was organized, regulated, and conducted with a certain formal dignity that reflected the culture around it. These were no longer simply markets, they were institutions with all the weight and permanence that word implies. but it was across the Atlantic, in a young nation just finding its footing, that perhaps the most famous of these formal exchanges would take root. In New York, in the late 1700s, traders gathered under a buttonwood tree at 68 Wall Street. They weren't looking to build an empire. They were simply trying to bring some order to their daily business. The tree provided shade, a natural meeting spot, just as the coffee houses had in London. But New York was growing rapidly, and outdoor trading had its limitations. The weather, the noise, the lack of privacy. So, on May 17, 1792, 24 of these merchants and brokers signed what became known as the Buttonwood Agreement. It was a simple document, just a few sentences, but it contained a profound promise. They agreed to trade only with each other, to set fixed commissions, and to give preference to each other's offers. Imagine you and your neighbors deciding to create a little trading circle where you promise to buy from and sell to each other before looking elsewhere. It was a pact of mutual support, a way of saying we're in this together. This humble agreement under a tree would become the seed from which the mighty New York Stock Exchange would grow. As the 19th century dawned, the need for a permanent home became clear. The traders moved indoors, first to rented rooms, then to their own building. The New York Stock and Exchange Board, as it was initially called, established regular trading hours, formal membership requirements, and rules about how securities could be listed and traded. It was becoming less like a marketplace and more like, well, think of a library. In a good library, there's a system. Books are organized. There are rules about borrowing. There's a quiet atmosphere conducive to study and reflection. The early stock exchanges were trying to create that same kind of orderly environment for capital. They wanted finance to be less like a shouting match and more like a careful conversation. What's beautiful about this evolution is how it mirrored the growth of the societies around these exchanges. As London, Paris, and New York grew from bustling towns into world cities, their financial markets grew with them. The formal exchanges became anchors of stability in increasingly complex economies. They provided a place where trust could be institutionalized, where your word was backed by the reputation of the exchange itself, not just your personal honor. These formal structures also allowed for something remarkable: specialization. Just as in a well-organized kitchen, where different chefs focus on different courses, exchanges allowed different types of traders to develop expertise. Some focused on government bonds, others on railroad stocks, still others on commodities. This specialization made the whole system more efficient, more capable of handling the growing volume and variety of financial instruments. But here's something to contemplate as you drift towards sleep. All of this was still physical. People gathered in buildings. They shouted bids and offers. They exchanged paper certificates. They recorded transactions by hand in ledgers. The world they were building was becoming more organized, more sophisticated, but it was still a world of tangible things, of pen and paper, of marble floors and wooden benches, of human voices calling out numbers across a crowded room. This physicality would define finance for the next century and a half. But even as these grand exchanges solidified their place in the economic landscape, the seeds of their transformation were already being planted. The telegraph would soon connect distant cities, making it possible to trade across continents. The ticker tape would spew out prices in real time. The telephone would allow instant communication between trading floors and offices. The formal structures were firmly established, but the technological winds of change were beginning to stir, whispering of a future where trading would no longer be constrained by physical space, where markets could exist in the ether between machines. For now, let those early exchanges stand in your mind, solid, permanent, impressive in their marble and wood grandeur. They represent a crucial chapter in our story, the moment when markets became institutions, when wild trading found its home and settled in, ready for the quiet revolutions still to come. As we drift from the mechanical clatter of the pit and the frantic hand signals of traders, we find ourselves stepping into a quieter room, one filled with a different kind of magic. The gentle hum of electricity was beginning to replace the roar of the crowd. And here, in this new era, our story introduces two remarkable inventions, the telegraph and the ticker tape. Think of them as the first whispers of a global conversation, a way for markets to speak across great distances in a language of dots and dashes, clicks and clatters. Before they arrived, information traveled as slowly as a sailing ship or a horse-drawn coach. The price of a stock in New York one morning might be days or weeks out of date by the time a merchant in San Francisco heard it. The market was a collection of isolated islands, each with its own time, its own truth. Then came Samuel Morse with his code and the wire that could carry it. The telegraph was like a nervous system for the continent, a network of copper threads stitching the coasts together. For the first time, a piece of news, a bid, an offer could travel faster than the wind. A financial tremor in one city could be felt in another in minutes, not months. The stock market was no longer just a physical place you went to. It was becoming an idea you could connect to, a pulse you could feel through a wire. And from this pulse, a new rhythm was born. If the telegraph was the nervous system, then the ticker tape was its gentle, incessant heartbeat. Invented by Edward Callahan in 1867, it was a marvel of simplicity. Picture a narrow strip of paper, fed through a machine that clattered to life whenever a trade was made far away in some great exchange hall. With each transaction, a little hammer would stamp the stock's symbol and its price onto that paper tape, which would then spool out into a waiting basket or onto the floor. The sound was distinctive, a rapid metallic click, click, clickety-clack, a sound that would become the white noise of finance for nearly a century. It was information made physical, made tangible. A broker in a small town office could watch the tape unfurl like a financial river, reading the rise and fall of fortunes in real time. The tape didn't shout, it narrated. It told a continuous, unedited story of supply and demand, of fear and greed, written in numbers and abbreviations. There was something almost poetic about it. The entire mood of a trading day, calm, frenzied, optimistic, bleak, was translated into the speed of the click and the length of the paper trail cascading to the floor. A quiet day might produce only a gentle trickle of tape. A panic would create a blizzard of paper, a torrent of clicking that filled the room with its urgent song. People would read the tape not just for prices, but for feeling, for the pace of the market itself. It democratized information in a way nothing had before. You didn't need to be on the floor of the exchange to know what was happening. You could be in a hotel lobby, a barber shop, a brokerage office, anywhere a ticker machine was connected. The market's secret language was being broadcast, letter by letter, number by number, to anyone who cared to listen. It turned spectators into participants, however small their part. The office with a ticker machine became a portal, a window looking directly onto the heart of the financial world. And with that window came a new kind of intimacy with the market's movements. Yet for all its magic, the ticker tape was still a mechanical creature. It was tied to a physical wire. It required paper and ink. Its messages could jam or tear. It was, in essence, a faster horse, a brilliant improvement, but not a fundamental transformation. It extended the reach of the market, but it was still broadcasting a conversation happening somewhere else, in a specific, crowded room. The revolution was in distribution, not in the nature of the conversation itself. The floor of the exchange, with its human drama, was still the stage. The ticker was just the microphone carrying the play to a wider audience. So we bid a gentle farewell to the rhythmic clatter of the ticker tape, to the paper trails that piled up like autumn leaves. Their work was done. They had taught the market how to speak at a distance, how to share its pulse with the world. They had prepared the ground, tilled the soil, for a much quieter, much faster, and far more profound revolution. The click of a mechanical hammer would soon be replaced by the silent blink of a light on a screen. The paper river would dry up, replaced by streams of electrons flowing through circuits of silicon. The age of physical information was giving way to the age of the virtual, the instantaneous, the digital. And as the last strip of ticker tape fluttered to the floor, a new invisible network was already humming, waiting to connect every corner of the globe in a web of light and logic. A quiet beginning to our next chapter. As we continue our gentle journey through the evolution of markets, we arrive at a quiet revolution that changed everything while hardly making a sound. It was a shift from the physical to the digital, from the audible to the silent, from the visible to the invisible. This was the computerization revolution, where markets left their physical homes and found new dwellings in the electronic networks that now span our globe. Imagine, if you will, a room that gradually empties, the voices growing quieter, the footsteps fading, the paperwork disappearing until only the soft hum of machines remains. This is what happened to the trading floor as computers began their quiet takeover. It started not with a bang, but with a series of gentle beeps and whirs as electronic systems began to record, process, and transmit information that had once flowed through human hands and voices. The first truly electronic exchange was created in a way that perhaps feels fitting for this transition, not in a great trading hall, but in a space that was designed specifically for this new kind of quiet commerce. It was called NASDAQ, and it opened in February of 1971, with no trading floor at all, no physical location where people gathered to shout and gesture and make deals. Instead, it existed solely as a network, a web of connections between computers. You can picture it as a vast, invisible constellation, with each computer acting as a star, connected by invisible lines of data. When a trader wanted to buy or sell a stock, they didn't shout across a room, they typed a command, and that request traveled along these invisible pathways until it found its match. The matching wasn't done by human intuition or by catching someone's eye across the floor. It was done by algorithms, by sets of rules written in code that could process thousands of transactions in the time it took a human to take a single breath. This transformation made trading faster, yes, but also more precise and more accessible. A small broker in a distant city could now participate in markets with the same speed as the largest firms on Wall Street. The electronic order book, which replaced the physical specialist's book, became a transparent ledger that everyone could see simultaneously. It was like moving from a private conversation overheard by a few to a public announcement heard by all. The shift was gradual, like watching the seasons change. At first, computers were just assistants processing paperwork that had become overwhelming, calculating prices, storing records. But then they began to do more of the work. They started matching orders, routing trades, even making decisions about when and how to execute. The floor trader with the sharp eyes and quick reflexes was being joined and sometimes replaced by the programmer with the elegant algorithm. The physical architecture of markets changed too. Where there once were great halls with columns and tall windows, there were now data centers with blinking lights and cooling systems. Where there was the smell of paper and sweat, there was the clean, sterile air of climate-controlled rooms. The soundscape transformed from the chaotic symphony of shouted bids and offers to the quiet hum of servers and the gentle clicking of keyboards. Yet even in this new electronic world, some familiar patterns persisted. The fundamental human desires to buy low, sell high, to invest in growth, to protect against loss, remained the same. The computer simply became a faster, more efficient way to express these desires. It was like replacing handwritten letters with email. The message was the same, but the delivery was transformed. This electronic infrastructure allowed markets to grow in ways that would have been unimaginable before. Trading volumes exploded, not because there were suddenly more traders shouting, but because each electronic connection could handle hundreds or thousands of transactions that would have taken human traders minutes or hours. Global markets became truly connected, with trades flowing seamlessly across borders and time zones. When the sun set on one exchange, the action simply continued in another part of the world, carried along by the unblinking networks that never slept. The transition wasn't always smooth, of course. There were glitches and crashes, moments when the electronic heart of the market skipped a beat. But with each challenge came new safeguards, new redundancies, new ways of making the system more resilient. The market learned to live in its new digital skin, adapting and evolving with the technology that sustained it. What's remarkable, when you think about it, is how this quiet revolution changed not just how we trade, but how we think about value itself. When prices changed not with the rhythm of human debate, but with the speed of light traveling through fiber optic cables, our relationship to those prices changes too. The market becomes less a place and more a process, a continuous flowing conversation happening in real time across the globe. And as we rest in this moment of transition between the physical markets of yesterday and the electronic markets of today, we can feel the ground shifting toward the next evolution. Because once markets moved into these electronic networks, they began to develop new kinds of relationships, not just between buyers and sellers, but between the participants themselves. The technology that connected them began to change how they thought, how they felt, how they behaved in this new digital arena. And that brings us gently to the human side of this transformation, to the psychology and social dynamics that emerged when markets became less about places and more about spaces. But for now, let that transition rest in your mind like a gentle turning of a page. Now, as we drift further into the gentle evolution of markets, we come to perhaps the most fascinating current of all, the human element that flows beneath the surface of every price, every trend, every boom and bust. This is the realm of market psychology and behavior, where the rational calculations of economics meet the deep waters of human emotion. Imagine, if you will, a vast crowd gathered in a great hall. Each person makes decisions for themselves, but they are all breathing the same air, feeling the same shifts in the atmosphere, hearing the same whispers that travel from one side of the room to the other. This is what markets truly are, collective moods and movements of the human spirit. The numbers on the screen are just the shadows cast by the dance of our hopes, our fears, our dreams of prosperity, and our nightmares of loss. Think about how our minds work when faced with uncertainty. We have a natural tendency to follow the crowd, to find comfort in moving with others. This is what economists call herding behavior. It's that same instinct that makes us feel safer walking in a well-lit area where others are present, rather than taking a deserted path alone. In markets, this instinct manifests as a powerful force. When prices begin to rise, we see others buying, and our brain tells us, they must know something I don't. So we join in. And as more people join, the movement gains momentum, like a snowball rolling downhill, gathering mass and speed. This is how bull markets are born, not just from fundamental economic strength, but from a gathering psychological energy, a shared belief in upward motion. But this very same mechanism works in reverse. When fear enters the room, it spreads like a chill. One person's nervousness becomes another's anxiety, and soon the entire crowd is moving toward the exits. This is the psychology of a crash. It's not just about numbers falling, it's about confidence evaporating, trust dissolving, and that collective belief in growth turning into a collective fear of loss. The famous economist John Maynard Keynes once called this animal spirits, those waves of optimism and pessimism that wash over markets, carrying prices far beyond what pure reason would dictate. Now, consider another powerful force in our psychology: our tendency to remember recent events more vividly than distant ones. This is called recency bias. After years of rising prices, we begin to believe that this is simply how things work, that the upward trend will continue indefinitely. We forget the lessons of history, the cycles that have always governed markets. This creates what's known as a bubble, a period when prices detach completely from underlying reality, floating higher and higher on nothing but collective belief. It's like a child blowing soap bubbles on a summer day. Each one shimmers with beautiful rainbow colors, growing larger and more beautiful until it pops. And when it pops, the psychological shock is profound. All that belief, all that confidence vanishes in an instant. Throughout history, we've seen this pattern repeat. The Dutch tulip mania of the 1630s, when single tulip bulbs traded for more than houses. The South Sea bubble of 1720, when shares in a company with vague promises of trade in South America soared to unimaginable heights. The roaring 20s stock market boom that preceded the Great Depression. The dot-com bubble of the late 1990s, the housing bubble that led to the 2008 financial crisis. Each time, the same psychological forces were at work, the same herding, the same recency bias, the same euphoria followed by the same despair. But it's not just about greed and fear. There's another quieter force at work: our aversion to loss. Psychologists have found that the pain of losing something feels about twice as powerful as the pleasure of gaining something of equal value. This means we'll go to great lengths to avoid a loss, even if it means missing out on potential gains. In markets, this leads to what's called the disposition effect, where investors tend to sell winning investments too early to lock in gains, while holding on to losing investments too long in hopes they'll recover. It's like a person who, after finding a beautiful seashell, immediately puts it in their pocket to keep it safe, but who keeps walking past broken shells, hoping to find one that's perfect, even as the tide comes in. Then there's overconfidence, that quiet voice inside that tells us we know better than the crowd, that we can time the market perfectly, that we see patterns where others see chaos. This is what leads people to trade too frequently, to take excessive risks, to believe they found the secret that eludes everyone else. It's the same feeling a gambler gets at a roulette table after a few wins, that sense of being in tune with the universe, of having a special insight. But markets, like the roulette wheel, have their own logic, and overconfidence often leads to painful lessons. And what about confirmation bias? That tendency we all have to seek out information that supports what we already believe, while ignoring or discounting information that contradicts it. In market terms, this means that once we've bought a stock, we tend to notice all the positive news about that company while filtering out the negative. We become attached to our decisions, defending them even when the evidence suggests we should reconsider. It's like falling in love with an idea and then seeing only its beauty while remaining blind to its flaws. Yet within all this psychological complexity, there's a certain symmetry, a rhythmic pattern that emerges over time. Markets move through cycles not just of economic expansion and contraction, but of psychological seasons. There's the spring of optimism when new ideas take root and confidence begins to grow. The summer of euphoria, when everything seems possible and caution is thrown to the wind. The autumn of anxiety, when doubts begin to creep in and the first leaves of fear start to fall. And the winter of despair, when confidence freezes and everything seems bleak. But then, always, spring returns. New ideas emerge. Confidence slowly rebuilds. The cycle begins again. These psychological patterns are not flaws to be eliminated, but rather inherent features of markets as human creations. They're the breath and heartbeat of the system, the expansion and contraction of collective confidence. Understanding them doesn't give us the power to control them, any more than understanding the ocean's tides gives us power to stop them. But it does give us perspective. It helps us recognize when we're being carried by the current of collective emotion and perhaps choose to swim against it when necessary. So as we reflect on market psychology, we begin to see markets not as cold, calculating machines, but as living reflections of ourselves, our hopes, our fears, our capacity for both wisdom and folly. They are mirrors held up to humanity, showing us not just how we allocate resources, but how we think, how we feel, how we dream together. And as these psychological currents flow through history, creating waves of prosperity and troughs of despair, societies have gradually learned to build structures to contain them, to channel them, to prevent the most destructive floods, while still allowing the vital waters to flow. These structures, the regulatory frameworks that emerged from crisis and reflection, are what we'll explore as we continue our gentle journey into how markets have evolved to understand and manage their own psychology. In the aftermath of 1929, after the great crash that shook the financial world to its core, something remarkable began to emerge from the rubble. It was a quiet realization, not a sudden flash, but rather something that slowly dawned on society like the first light after a long dark night. Societies around the globe began to understand that markets, left entirely to their own devices, could sometimes build themselves up beyond their natural limits, creating structures that were elegant on the surface but fragile at their core. Picture it like a beautiful bridge, engineered with breathtaking arches and delicate supports, but without proper foundations or regular inspections. It might stand for years, admired by all, until one day, under just the right pressure, it begins to tremble and then it falls. The Great Depression was that collapse, and from it emerged the first serious efforts to build what we now call market regulation. You see, before that time, financial markets operated much like a vast, unsupervised playground. There were rules, of course, but they were like the informal agreements between children at play, sometimes honored, sometimes ignored, with no one truly in charge of keeping peace. After the crash, governments began to realize that markets needed something more structured, something akin to a careful gardener tending a magnificent but wild orchard. The gardener doesn't prevent the trees from growing or the fruit from ripening. Instead, they prune the overgrowth, remove diseased branches, ensure proper spacing between trees, and watch for signs of trouble before it spreads. They create conditions for healthy, sustainable growth rather than explosive, unstable expansion. This was the philosophy behind the creation of the Securities and Exchange Commission in the United States under Franklin D. Roosevelt's administration in 1934. Think of the SEC not as a strict disciplinarian, but as a wise overseer, the first of many guardians who would watch over the financial landscape. Their role wasn't to stop trading or prevent innovation, but to ensure transparency, to make sure that everyone playing in the marketplace had access to the same basic information. Before regulation, it was possible for a few insiders to know critical details about a company while ordinary investors remained in the dark. Imagine trying to navigate a dense forest at night with only a candle while others have floodlights. It wasn't a fair contest. The SEC's initial mandate was to simply turn on the lights, to require companies to disclose their financial health, their risks, their true situation, so all market participants could make informed decisions. As decades passed, the regulatory framework evolved, shaped by new challenges and changing circumstances. The financial landscape grew more complex, with new instruments and markets emerging like tributaries branching off a great river. Each new development required new forms of oversight, not to restrict the flow of capital, but to ensure it didn't overflow its banks and flood the surrounding countryside. The metaphor here is important. Effective regulation isn't about building dams to stop the river, but about creating levees and channels to guide its flow, allowing it to nourish the land without causing destruction. In the 1970s, we saw the establishment of the Commodity Futures Trading Commission, which took on the task of overseeing the rapidly growing world of futures and derivatives. These instruments, which allowed businesses to hedge against future price changes, were like sophisticated locks on a canal system, useful for managing water levels, but potentially dangerous if not properly maintained. The CFTC became the engineers who inspected these locks, ensuring they functioned as intended without creating unexpected backflows or pressure surges. The evolution continued through financial crises and booms, each event teaching regulators new lessons about how markets could fail in unexpected ways. The savings and loan crisis of the 1980s, the dot-com bubble of the 1990s, and most dramatically, the global financial crisis of 2008, each revealed weaknesses in the regulatory framework that required thoughtful, measured responses. After 2008, we saw the creation of the Financial Stability Oversight Council and the Consumer Financial Protection Bureau in the United States, while internationally, the Basel Accords strengthened banking regulations worldwide. These weren't reactions born of panic, but rather careful adjustments to a system that had grown too interconnected, too complex, too opaque. Consider modern financial regulation as a kind of symphony orchestra, with each regulatory body playing a different instrument. The SEC oversees public markets, the CFTC monitors derivatives, banking regulators watch over lending institutions, and international bodies coordinate across borders. When they play in harmony, they create a stable environment where capital can flow, innovation can occur, and economic growth can proceed steadily. When one section falls out of tune or plays too loudly, the entire financial symphony can become dissonant, jarring to the ear and ultimately unsustainable. The contemporary regulatory landscape is constantly evolving, adapting to new technologies like algorithmic trading, cryptocurrencies, and global digital markets that never sleep. Modern regulators face the challenge of overseeing markets that operate 24 hours a day across every time zone, where capital moves at the speed of light through fiber optic cables beneath oceans and across continents. They must balance the need for stability with the desire for innovation, protecting consumers without stifling growth, ensuring transparency without creating burdensome bureaucracy. This gentle evolution of market regulation represents one of humanity's great collective achievements, the recognition that complex systems require thoughtful stewardship to function well over the long term. It's the application of wisdom to power, of restraint to opportunity, creating structures that allow markets to serve their essential purpose, connecting those with capital to those with ideas, facilitating exchange and enabling progress while minimizing unnecessary harm. The journey from the unfettered playgrounds of the 1920s to today's carefully tended financial ecosystems shows how societies learn and adapt, building resilience through experience and foresight. And now, as our financial world has become truly global, interconnected in ways our predecessors could scarcely imagine, we begin to see how these regulated markets have created a new reality, one where trading never stops, where sunrise in Tokyo signals the opening of markets that will remain active until sunset in New York. This constant flow of capital and information across borders has created what we might think of as a financial heartbeat for our planet, pulsing with the rhythm of human enterprise around the clock. As we drift into this next chapter, let us imagine for a moment that the world is a vast, slumbering garden. The sun sets on one patch of earth, tucking its flowers into darkness, but on another continent, dawn breaks, stirring different blossoms to life. For most of human history, these gardens existed in relative isolation, each following its own daily rhythm. But then we began to thread them together, creating a continuous, interconnected ecosystem where life and trade could flow across the globe without ever truly stopping. Welcome to the era of globalization and 24-hour trading. Think back to those early localized exchanges, those bustling town squares or coffee houses. They were like small, self-contained ponds. Life teemed within them, but it was separate from the pond over the next hill. Then came the telegraph, those first underwater cables, the telephone. These were the streams we dug between our ponds, allowing currents to flow and mingle. A trade in London could now send ripples to New York, though the ripples might take hours or days to arrive. The ponds were becoming connected, forming a lake. But true globalization, the creation of a single planetary ocean of commerce, required a profound shift in perspective. It asked us to see time not as a fixed experience, but as a relative one. The sun was always shining somewhere. When the bell tolled the end of the trading day on the floor of the New York Stock Exchange, it was already morning in Hong Kong and midday in London. The market didn't have to sleep just because Wall Street did. It could simply hand off its activity like a baton in a never-ending relay race to another financial center already awake and ready to run. This evolution created what we now call the 24-hour market. It is not a single giant building that is always lit, but rather a beautiful global carousel. Picture a magnificent, slowly rotating platform with horses representing major financial hubs: Tokyo, Hong Kong, Singapore, London, New York. As one horse begins its descent into the evening, another rises into the bright light of a new business day. The music never stops. The platform keeps turning, and the global market, the collective activity of all those riders, continues its endless, graceful circle. This interconnectedness fundamentally changed the nature of markets. A company listed on a stock exchange was no longer just a local concern, scrutinized by local investors. It became a global entity. An investor in Paris could wake up and buy shares in a technology firm based in Seoul or a mining company operating in Australia as easily as they could buy a baguette from their local bakery. Capital became borderless, flowing to wherever opportunity beckoned, drawn by signals transmitted instantly across fiber optic cables and satellite networks. This global village, however, also meant that a sneeze in one corner of the world could cause a cold in another. The financial crisis that began with complex mortgage securities in the United States in 2008 didn't stay contained. It rippled outward through this tightly woven global fabric, affecting banks in Europe, manufacturers in Asia, and pension funds worldwide. The interconnectedness that brought stability through diversification also created new channels for volatility to travel. The market's mood, whether of exuberant optimism or deep-seated fear, became a contagion that could cross oceans in milliseconds. This era also gave birth to the currency markets, the forex, which operate in a state of perpetual motion. While stock exchanges have opening and closing bells, the market for trading one nation's currency for another truly never closes. It is the most liquid, constant market in the world. It's the deep, rhythmic pulse of the global ocean, the endless ebb and flow of value between yen and dollars, euros and pounds, dictated by trade, investment, and the subtle perceptions of entire economies. The shift was cultural as much as it was technological. Traders and analysts began to live by world clocks, not just local time. Breakfast might involve reading reports from Asia. The afternoon could be spent on calls with Europe, and the evening might be dedicated to monitoring the opening on the west coast of the United States. The workday stretched and morphed, becoming a tapestry woven from threads of time zones. The sun, quite literally, never set on the global market. For the individual investor, this was both empowering and daunting. It offered unprecedented access and choice, but it also demanded a new kind of awareness, an understanding that news breaking overnight on another continent could fundamentally alter the value of their holdings by the time their own market opened. The world's events, from political elections to natural disasters to central bank decisions, were no longer distant headlines. They were immediate market-moving forces. their impact felt in portfolios everywhere. This gentle evolution towards a global continuous market represents one of the most profound quiet revolutions in finance. We moved from isolated ponds to a single vast ocean. We learned to trade not just across streets, but across hemispheres. We accepted that the market's heartbeat is constant, a soft, persistent rhythm underlying the turning of the planet itself. It created a system of incredible complexity and resilience, where capital is always in motion, seeking its most efficient use, knitting the world's economies together in an intricate, silent dance. And as this global carousel continues its endless turn, it sets the stage for the next quiet transformation. For technology was not finished reshaping the landscape of trade. The very tools that connected our world would soon begin to interpret it, analyze it, and even participate in its rhythms in ways we were only beginning to imagine. A new digital pulse was about to join the heartbeat of the global market. If you close your eyes and imagine the markets of the 20th century, you might picture bustling trading floors, brokers shouting across crowded rooms, pieces of paper flying through the air, a chaotic human symphony. But in recent decades, a quiet transformation has been taking place. The shouting has been replaced by humming, the paper by pulses of light. The human traders have been joined, and in many cases superseded, by lines of code. We've entered the realm of algorithmic trading, where markets are shaped by the logic of mathematics, executed with silicon precision at speeds the human mind can hardly comprehend. This is our quiet evolution into the digital age of finance, where the market's pulse has accelerated to the rhythm of computer cycles. Think of a traditional investor, someone who might take days to research a company, contemplate its value, and then place an order that would be filled minutes or hours later. Now imagine a different kind of participant, one that isn't human at all. It's a set of instructions, a program, watching thousands of data points every second. It doesn't ponder meaning. It scans for patterns, for imbalances, for opportunities measured in thousandths or millionths of a second. It makes decisions and executes trades before you could finish blinking. This is the world of algorithmic trading, the foundational layer of modern market structure. An algorithm is simply a recipe, a very precise step-by-step set of instructions to solve a problem. In trading, that problem is often how to buy or sell a large amount of stock without moving the price against you. Let's use a simple metaphor. Imagine trying to move a very large, heavy piece of furniture through a narrow doorway. If you try to push it all at once, you'll jam it, strain yourself, and possibly damage the door frame. A more effective strategy is to tilt it, slide it an inch, adjust the angle, slide it another inch. You break the big task into many tiny manageable tasks. This is the core purpose of a large, patient algorithm, what's known as a large order execution algorithm. It takes a giant order from a pension fund or mutual fund, which might be to buy 100,000 shares of a company, and it carefully, methodically slices that order up. It feeds tiny pieces of the order into the market over time, disguised among thousands of other trades, to find the other side of the transaction without announcing its full intention to the world. It's a dance of stealth and patience, conducted by unfeeling, unerring code. But on another scale entirely exists a different breed of algorithm. These aren't the patient furniture movers. They are the hummingbirds, flitting at impossible speeds, hovering for mere moments, sipping the smallest drops of nectar before darting away. This is the world of high-frequency trading, or HFT. While algorithmic trading is the broad category, high-frequency trading is a specific, intense subset. These firms use incredibly powerful computers located physically as close as possible to the exchange's own servers to execute trades in microseconds. A microsecond is 1/1,000,000th of a second. In the time it takes for light to travel from your eye to this page, a high-frequency trading firm could have placed, modified, and cancelled thousands of orders. Their goal is not to invest in companies for the long term. Their goal is to capture tiny, fleeting price differences, differences so small they are invisible to human traders. Picture two nearly identical clocks side by side. To your eye, they show the same time. But if you had a microscope, you might see that one second hand is a fraction of a millimeter ahead of the others. A high-frequency trader is that microscope, but for prices. If the same stock is trading for $100 on exchange A and $100 or once on exchange B, the HFT firm will buy it at $100 on A and instantly sell it at $100 one on B. The profit is 1/10 of a penny per share. But if you do that millions of times a day, those tenths of a penny add up. This practice is called arbitrage, and it's been a function of markets for centuries, buying low in one place and selling high in another. What changed is the speed and scale. The old arbitrageur might have taken minutes to place a call from New York to London. The new one does it in less time than it takes a nerve signal to travel from your brain to your finger. This transformation has fundamentally reshaped the microstructure of the market, the very plumbing and wiring through which trades flow. Markets today are a network of electronic exchanges and dark pools, all connected by fiber optic cables. Liquidity, the ability to buy or sell an asset quickly without affecting its price, has evolved. HFT firms now provide a significant portion of the visible bids and offers in the market. They are constantly quoting prices, ready to buy or sell, creating a dense, ever-present ocean of potential trades. This can make markets look very liquid on the surface. The spread, the difference between the highest price a buyer will pay and the lowest price a seller will accept, has narrowed dramatically. which is generally good for everyday investors. But this liquidity has a particular character. It is ephemeral. It can appear and vanish in an instant. The hummingbird can be feeding one moment and gone the next if the conditions change. In times of extreme stress, this can lead to what's known as a flash crash, a sudden, deep, and brief market plunge driven by algorithmic feedback loops. In May 2010, in a matter of minutes, the Dow Jones Industrial Average fell nearly 1,000 points, only to recover most of the loss just as quickly. It was a stark demonstration of how automated systems interacting at superhuman speeds can create unforeseen volatility. One algorithm, reacting to selling pressure, began aggressively selling. Others, seeing this selling, reacted by pulling their own buy orders, their liquidity, from the market. With buyers disappearing, prices fell further, triggering more automatic selling. It was a cascade, a digital stampede, over in less than half an hour. The event was a profound lesson. The logic of algorithms is pure, but the system they create is complex and sometimes fragile. And so, our markets have become a hybrid ecosystem. The patient, long-term investors with their fundamental analysis and human judgment, the large, methodical algorithms that quietly digest big orders, and the high-frequency hummingbirds that stitch the market together with their lightning-fast arbitrage, creating a shimmering, ever-moving surface of prices. It's a system of immense mathematical beauty and remarkable efficiency, but one that operates on timescales that distance it from human experience. We have outsourced the mechanics of trading to machines that optimize for speed and precision in ways we never could. This quiet, relentless evolution from the clamor of the pit to the hum of the server farm has given us markets that are faster, cheaper to trade in, and more interconnected than ever before. But it also asks new questions. Questions about fairness, when speed itself becomes the ultimate competitive advantage. Questions about stability, when the guardians of liquidity can disappear in a microsecond. And questions about the very soul of the market. Is it still a mechanism for human capital allocation, or has it become a complex game played between computers for computers? For now, as we drift towards sleep, we can simply observe this new landscape. A landscape where value is still discovered, capital is still allocated, but the agents of that discovery move to a rhythm set not by the sun or the trading bell, but by the steady, silent pulse of the processor's clock. And as this chapter closes on our digital markets, we can begin to wonder, with this foundation in place, where does the evolution lead next? Imagine you're walking through a great symphony hall, but instead of one orchestra playing together on a single stage, you find many smaller ensembles scattered throughout the building. Each chamber group plays its own version of the same piece of music, some in grand halls, others in quiet side rooms with velvet curtains drawn. This is the modern stock market ecosystem. not a single unified trading floor, but a network of venues where stocks are bought and sold simultaneously, creating a complex harmony of activity that moves with its own gentle rhythm. At the center of this ecosystem are the traditional exchanges, the grand concert halls of finance, the New York Stock Exchange, the Nasdaq. These are the venerable institutions where trading has occurred for generations, where opening bells ring and traders once shouted across crowded floors. Today, much of that activity has moved to vast server farms, humming with the quiet energy of algorithms executing trades at speeds beyond human comprehension. But these exchanges still serve as the primary stages where prices are discovered and displayed for all to see, the reference points around which all other activity orbits. Now, step into one of those side rooms with the velvet curtains, the dark pools. These private trading venues operate away from public view, allowing large institutional investors to buy and sell substantial blocks of shares without immediately affecting the market price. Think of them as private salons where major collectors quietly exchange masterpieces without announcing their transactions to the auction house floor. The trades still occur, the ownership still transfers, but the process happens with discretion, preventing the market from reacting to each large transaction before it's completed. Dark pools handle significant volumes, yet their operations remain largely invisible to the ordinary investor, part of the hidden infrastructure that supports the market's surface activity. Between all these venues move the market makers, the musicians who keep the music flowing even when no one else is playing. They stand ready to buy when you wish to sell, and sell when you wish to buy, providing the liquidity that allows markets to function smoothly. Imagine them as the gentle currents in a vast ocean, always moving beneath the surface, ensuring that water flows where it's needed, maintaining balance and preventing stagnation. Market makers profit from the tiny differences between buying and selling prices, but in doing so, they perform an essential service. They ensure there's always someone on the other side of your trade, creating the continuous stream of activity we call a liquid market. The remarkable aspect of this modern structure is how seamlessly it operates. When you place an order for shares through your brokerage account, that order doesn't simply go to one exchange. It travels through a sophisticated routing system that searches across multiple venues simultaneously, checking the prices at different exchanges, looking for available shares in dark pools, evaluating whether market makers can provide a better price. This happens in milliseconds, a gentle dance of electrons across fiber optic cables spanning continents, all to ensure you receive the best possible execution for your trade. This fragmentation might seem like it would create chaos, but instead it creates resilience. If one venue experiences technical difficulties, others continue to operate. If trading becomes too volatile in one location, activity can shift elsewhere. The market has evolved from a single vulnerable point into a distributed network, Much like a forest ecosystem where life doesn't depend on any single tree but thrives through interconnected relationships between countless organisms. Yet this complexity raises gentle questions about transparency and fairness. When trading occurs across so many venues, how can anyone be sure they're seeing the complete picture? Regulatory systems have evolved alongside these technological changes, creating consolidated data feeds that aggregate information from all trading venues, attempting to provide what's called a national best bid and offer, the best available prices across the entire ecosystem. It's an imperfect system, constantly being refined, but it represents our collective effort to maintain fairness in an increasingly complex environment. As we drift through understanding this modern market structure, we might wonder how our individual minds interact with this vast distributed system. How do our hopes, fears, and dreams as investors find expression in these electronic networks spanning the globe? The relationship between human psychology and modern market participation creates its own gentle currents, flowing beneath the surface of all this technological sophistication, and it's there we'll turn our attention next. There's a quiet revolution that began to unfold in the late 20th century, one that would fundamentally reshape who could participate in the great theatre of markets. Before this shift, the stock market felt like an exclusive club, a grand concert hall where the orchestra played for a select audience of institutions and wealthy individuals. The ticker tape, the trading floors, the financial papers, all seemed part of a world that operated at a distance from ordinary lives. But then came a change so profound that it would make those very same markets accessible to anyone with an internet connection and a modest amount of capital. It began with online brokerages, those digital gateways that appeared on our computer screens and eventually in our pockets. Think of them as inviting front doors to what was once a walled garden, doors that didn't require special invitations or connections to open. A person could sit at their kitchen table after putting the children to bed, or during their lunch break at work, and with a few clicks, become part of the same marketplace where pension funds and billionaires made their moves. This wasn't just about convenience, it was about democratization. Suddenly, the market wasn't just something that happened to you through your retirement account or your company's stock. It was something you could engage with directly, with your own choices, your own decisions. With this accessibility came a new character in the market story. The retail investor. That's you, that's me, that's your neighbor or colleague who might mention something about a stock they've been following. We became participants rather than just spectators. But this new role brought with it a fascinating layer of complexity, because we brought our whole selves to the endeavor. And that includes something markets had traditionally tried to filter out through professional intermediaries: our emotions. You see, institutional investors, the pension funds, the mutual funds, the hedge funds, they operate with rules, with models, with teams whose job is to manage risk and emotion. They have checklists and protocols. But when you're sitting there at your kitchen table, making a decision about your own money, something different happens. You're not just processing numbers on a screen, you're processing feelings. The excitement of a stock going up, that little thrill you feel, or the sinking sensation when it goes down. You're making decisions not just based on what you know, but on how you feel. And this introduces some fascinating patterns into the market's movements. There's a phenomenon sometimes called the fear of missing out, or FOMO, where investors rush into a stock because everyone else seems to be buying it, because they're afraid of being left behind while others make gains. It's a bit like seeing a line forming outside a bakery. You might join it just because others are there, without really knowing if what's inside is what you actually want or need. And then there's the opposite, panic selling. When prices fall sharply, that instinct to pull out, to cut losses, can create a cascade effect where everyone sells at once, driving prices down even further. It's like watching a crowd start to move quickly in one direction in a public square. You might find yourself moving with them, not because you've decided where you need to go, but because the collective motion pulls you along. These emotional patterns are part of what makes markets so human, so relatable. They remind us that behind every trade, every price movement, there are people making decisions, people who feel hope when they invest in a company they believe in, anxiety when the market dips, regret when they sell too soon, or pride when they buy at just the right moment. These aren't flaws in the system, they're expressions of our humanity within the system. The interesting thing is that this emotional dimension has always been part of markets, but when access was limited to professionals, it was managed differently. Now it's out in the open, visible in the rapid movements of certain stocks, in the chatter on investment forums, in the stories people tell about their trades. And this visibility has changed how markets behave in subtle ways. It's added a layer of collective psychology to the fundamental analysis of companies, the technical analysis of charts, and the macroeconomic trends that have always guided investment. What's beautiful about this development is that it has made markets more personal, more connected to our individual lives. Your investment decisions might be about more than just returns. They might reflect your values, your beliefs about which industries will shape our future, your confidence in particular technologies or leaders. The market becomes not just a place to grow wealth, but a place to express your vision of what the world could be. Yet, this very personal connection raises important questions. If markets are now more accessible, more personal, more woven into the fabric of everyday life, what responsibilities come with that? Not just responsibilities for individual investors to be thoughtful and informed, but broader questions about markets themselves. What is their purpose beyond generating returns? How do they relate to the society they exist within? Do they serve us, or do we serve them? These are gentle questions worth pondering as we drift towards sleep, because they lead us naturally into considering the ethical dimensions of this system we've all become part of. Now, as we settle into this space of contemplation, let's gently consider how markets have begun to reflect not just financial values, but human values. You might think of it as markets waking up to their own conscience, like a person who, after years of focused work, suddenly looks up and wonders, what am I building all this for? Who does it serve? This is the quiet emergence of what we now call ESG investing, which stands for environmental, social, and governance factors. It's not just about profit anymore. It's about purpose woven into the very fabric of investment decisions. Imagine a garden that was once cultivated purely for yield. Every plant chosen for how much fruit it could bear, regardless of how it affected the soil, the insects, or the birds. Then, gradually, the gardener begins to notice the connections. They see that bees need flowers to thrive, that healthy soil produces not just more fruit, but better fruit, and that a diverse garden is more resilient to storms. That's what ESG investing represents, a recognition that financial systems exist within larger ecosystems, that companies affect the world around them, and that these effects matter. For a long time, markets operated on what you might call a narrow calculus. The only questions seem to be, does it make money? But ethical markets ask a deeper set of questions. How does it make money? Who benefits? Who might be harmed? What legacy does this activity leave for future generations? These questions transform investing from a mechanical exercise into a moral conversation. It's like moving from simply collecting stones to carefully choosing which stones to polish and set, knowing they'll become part of something beautiful and lasting. The environmental component of ESG considers how a company treats our shared planet. Does it contribute to climate change through excessive carbon emissions? Does it pollute rivers and oceans? Or does it actively work to restore, protect, and sustain the natural world? Think of it as asking whether a company is a guest who leaves a place better than they found it, or one who takes what they want and moves on. The social dimension looks at how a company treats people, its employees, its customers, the communities where it operates. Does it pay fair wages? Does it create safe working conditions? Does it respect human rights? Does it contribute to the communities it's part of? Or does it extract value and leave little in return? This is the heart of the matter, recognizing that behind every stock ticker, there are human lives being affected. Governance examines how a company is run. Is there transparency in its operations? Are there checks and balances against corruption? Does leadership reflect diversity of thought and experience? Good governance is like the foundation of a house. You might not see it when everything's working well, but when it's weak, the whole structure becomes unstable. What's remarkable about this evolution is how it represents markets catching up with something people have known intuitively for centuries, that value isn't just measured in dollars and cents. A forest has value beyond the timber it can produce. A community has value beyond the taxes it can generate. A worker has value beyond the hours they can contribute. Ethical markets are beginning to formalize this wisdom, creating systems that can measure and account for these broader forms of value. Sustainable investing represents a beautiful paradox. By considering factors beyond immediate profit, investors may actually create more lasting, resilient returns. A company that treats its workers well tends to have lower turnover and higher productivity. A company that minimizes its environmental impact is less likely to face costly regulations or reputational damage. A company with strong governance is less likely to suffer from scandals or mismanagement. It's like building a ship not just for speed, but for seaworthiness. It might not always be the fastest, but it's more likely to weather the storms and complete the journey. This shift toward ethical markets isn't just happening because it feels good, though that's part of it. It's happening because we're beginning to understand the interconnectedness of everything. A supply chain disruption halfway around the world affects local prices. Carbon emissions in one country contribute to climate patterns that affect agriculture everywhere. The well-being of workers in a factory influences product quality that reaches consumers across continents. Markets, in their wisest form, are beginning to reflect this web of connections. Some people worry that ethical considerations might dilute financial returns, but the evidence suggests otherwise. Numerous studies have shown that companies with strong ESG practices often perform as well as or better than their peers over the long term. It's as if the market is slowly discovering that doing good and doing well aren't mutually exclusive. They can be, and perhaps should be, complementary goals. This evolution also represents a democratization of values in finance. Individual investors, large pension funds, and everything in between are increasingly asking their fund managers to consider these factors. People want their investments to align with their values. They want their retirement savings to support companies that make the world better, not worse. It's a quiet revolution happening in brokerage accounts and retirement plans around the world. The most beautiful aspect of this movement might be how it reconnects finance with its original purpose. Finance was never meant to be an end in itself. It was meant to be a tool for building things, for creating value, for supporting human flourishing. When a farmer takes out a loan to buy seeds, that's finance serving life. When a community pools resources to build a school, that's finance serving society. Ethical markets and sustainable investing are returning finance to this deeper purpose. So as we watch this gentle evolution unfold, we can see markets becoming not just mechanisms for allocation, but reflections of collective values. They're learning to measure what matters, to account for externalities, to consider the long arc of consequences. It's a slow awakening, like dawn gradually illuminating a landscape, revealing connections that were always there but easier to see in the growing light. And as we consider this transition toward more conscious capitalism, we begin to approach the deeper philosophical questions that have been waiting patiently in the background. Questions about what markets really are, what they represent, and what they might become. Imagine, if you will, that you could stand back and view the entire marketplace from a great distance. Not as individual shops and stalls, not as bustling exchanges with their shouting traders, but as a single living entity. A vast breathing organism made of pure information. That's what we're going to explore now. Markets as information systems. Think of it this way. A healthy forest doesn't have a central planner telling each tree when to grow or each mushroom when to fruit. Instead, the entire ecosystem operates through an intricate dance of signals, sunlight, temperature, moisture, nutrients that travel through fungal networks we're only beginning to understand. The forest feels its way forward, constantly adjusting, constantly learning, without any single brain making conscious decisions. Markets, in their most evolved form, operate similarly. They are not just places where goods are exchanged for money. They are complex information processing systems, living libraries of human knowledge, preferences, fears, and hopes, all distilled into a single flowing stream of data, the price. Every price you see, whether for a loaf of bread or a share in a company, is not simply a number. It is, in a deep sense, a message. It's a tiny, compressed signal that contains within it an astonishing amount of information. The price of that loaf tells you about the cost of wheat, the baker's skill, the rent on the shop, the demand from the neighborhood, the weather that affected the harvest, the taxes on the flour, and the dreams of the person who built the oven. All of it wrapped up in a single quiet figure. It's as if you took 1,000 whispered conversations, 100 secret observations, and 50 unspoken predictions, and you condense them all into one gentle hum. That hum is the price alone. It's just a sound. But when you listen to the chorus of millions of such hums, the price of bread, of steel, of company shares, of borrowed money, you begin to hear the whispered story of an entire society. You hear what people value, what they fear will become scarce, where they think opportunity lies, and where they sense danger approaching. The market, in this view, becomes a giant decentralized mind, far too complex and subtle for any one person or any committee of people to ever fully grasp. No single planner could know that a drought in one country makes a certain fertilizer more valuable, which affects the cost of feed for chickens, which changes the price of eggs, which influences how a family on the other side of the world plans their breakfast. Yet the market, this sprawling information system, feels all these connections. It processes them not with logic, but with something closer to intuition. Each person participating, the the farmer worrying about rain, the baker choosing flour, the investor reading a report, adds their own little piece of knowledge, their own private concern, to the great collective calculation. This is why attempts to control markets too tightly often falter. It's not merely a matter of suppressing freedom, it's a matter of trying to replace a symphony orchestra with a single loud horn. When you try to set a price by decree, you are in effect turning off a million tiny microphones. You are silencing the whispers about scarcity, about quality, about changing tastes. You are saying the central planner's single voice is louder and wiser than the quiet, collective murmur of everyone involved. And in doing so, you lose the information. The system grows deaf to itself. It can no longer feel its way through the forest of reality. It begins to stumble because it is operating in the dark, guided only by the dim flashlight of a limited human perspective, rather than being illuminated by the soft ambient light of shared, dispersed knowledge. The beauty of this system is that it works without anyone needing to understand the whole. The baker doesn't need to know meteorology to respond to a grain shortage. She simply sees the price of flour rise and she adapts. Maybe she bakes smaller loaves or uses a different recipe. Her adaptation, in turn, sends a new signal back into the system. It's a constant, gentle feedback loop, a conversation that never ends. We are all, in our small ways, both speakers and listeners in this conversation. When you choose to buy one thing over another, you are casting a vote. You are adding your own tiny data point, your own whisper of this, not that, to the collective intelligence. Your preference for local honey over imported sugar, your decision to save rather than spend, your choice to invest in a company you believe in, each act is a signal, and all these signals flow together, merging and blending to paint a picture of value that is more detailed, more nuanced, and more truthful than any one of us could ever paint alone. So as you lie here resting, consider this gentle thought. The hum of commerce you might hear in the distance, or simply sense as the background rhythm of daily life, is more than just noise. It is the sound of a society thinking. It is the quiet, persistent processing of our collective experience, our collective wisdom, and even our collective mistakes. It is an information system of breathtaking elegance, evolving not through force, but through countless tiny adjustments, each one a quiet response to a whispered signal from the world. It is a forest feeling for the sun, a mind too vast for any single thought. And its journey is not yet finished. And as we approach the edge of this understanding, we can begin to look back on the entire path we've walked together. As we come to the close of our gentle journey through the evolution of markets, I want you to picture something with me. Imagine a great, slow-moving river. It's not a rushing torrent or a tiny stream, but a wide, deep current that's been flowing for thousands of years. This river has carved its way through landscapes, shaped civilizations, and carried countless vessels on its surface. And like that river, markets too have been flowing, slowly and persistently, through the landscape of human history. They began as simple gathering places along ancient riverbanks, and today they flow through fiber optic cables and digital spaces. But at their heart, they still carry the same essential purpose: connecting what people need with what people have, connecting dreams with resources, connecting yesterday's surplus with tomorrow's scarcity. The wonderful truth as you drift towards sleep is that this evolution continues. It doesn't stop when we close our eyes or when markets close for the day. Even now, as you're listening, somewhere a farmer is considering what to plant next season. A baker is experimenting with a new recipe. A programmer is writing code for a new platform that might change how we connect with one another. The gentle hum of commerce and creation continues, an endless background melody to human civilization. Sometimes we think of change as disruptive, as breaking something that was whole. But what if we thought of it instead as a garden you planted long ago, now growing in directions you couldn't have predicted? The seed you planted, the simple barter, the first coin, the ancient trade route, has grown into something far larger than you could have imagined, yet it's still recognizably the same plant, just older, more complex, more intertwined with everything around it. Markets have always been one of humanity's most profound conversations, not with words, but with choices and values and trust. And like any good conversation, they evolve, they adapt, they respond to new information. They make mistakes and correct them. They create new possibilities we never could have anticipated. And here's the most soothing thought of all. This gentle evolution is largely self-organizing. No single person directs it. No central planner controls it. It emerges from millions of small decisions, like starlings creating those breathtaking murmurations that flow through the sky as one beautiful living organism. Each bird follows simple rules, paying attention to its neighbors, and from that emerges something extraordinary and fluid. So, as you settle into sleep tonight, let this thought comfort you. The world is not static, it's not fixed or frozen. It's living, breathing, evolving. And just as the markets of the past adapted to serve the needs of their time, so too will today's markets slowly transform to serve tomorrow's world. They will find new ways to connect us, new ways to meet our needs, new ways to help us share with one another. This continuous, gentle evolution is the background rhythm of civilization itself, and you are part of it. Every time you choose something, every time you create something, every time you share something, you're adding your small note to this endless flowing conversation. Now, as our own conversation comes to a close, let that river of commerce and connection flow gently in your mind. Let those starlings of human exchange dance their graceful patterns across the sky of your thoughts, and let yourself drift, knowing that this beautiful, complex, ever-evolving system continues even as you rest. Your mind can release all need to understand or control it. It simply flows as it always has, as it always will. And now letting that flow carry you gently towards sleep.